I'll make a column here for weighted average. In both scenarios, I had sales of $2, and I have cost of goods sold. In the LIFO, I'm sorry, wait, let me put these into the same order, FIFO and LIFO. Under FIFO, my cost of goods sold was 45 cents. So my gross profit was $1.55. Under LIFO, my cost of goods sold was 85 cents. So my gross profit was $1.15. So look at the difference there. Let's add another column, inventory value. Under FIFO, my inventory value was $1.50. Under LIFO, my inventory value was $1.10. Look at the difference there. Now, which one gives you more profit? FIFO is the more profitable one, right? Because FIFO is giving me gross profit of $1.55, whereas LIFO is only giving me gross profit of $1.15. If you were an investor reporting your results to shareholders, which would you rather use, FIFO or LIFO? Oops, shouldn't shake up a bottle of soda. Which?
FIFO.
Yeah, FIFO. Why?
You have greater gross profit.
Yeah, you want to look as profitable as possible, right? If you're filing a tax return, which one would you rather use? LIFO, because then you want to have as little profits as possible, right? So it'd be the best case scenario if you could use FIFO to present your earnings to your shareholders and present LIFO to the IRS. Because this way you could look good with your shareholders, but to the IRS you look not so profitable. This is going to be the case, by the way, when prices are going up. If prices are going down, it's going to go in the opposite direction. LIFO will present you higher profits and higher inventory value, whereas FIFO will have lower profits and lower inventory value. So this is under an assumption of increasing prices. Assume increasing prices. Let's try something else. It's called weighted average. The way weighted average works is that, is there anyone here who has a preference, LIFO, FIFO yet? You kind of feel partial to one or the other? No? You sort of feel even-handed, like you could take one or the other, it doesn't really make a big difference? No favorites yet? You like FIFO?
For food-wise.
Food-wise, yeah, because LIFO leaves the old stuff. For taxes, you would never.
Inventory-wise,
never. You never use LIFO on your inventory because you don't want inventory sitting around doing nothing. You have to constantly rotate your inventory. So maybe like an antique business, you know. But even that, you're never gonna use LIFO.
Are you allowed to report FIFO and LIFO?
So the story is that for your financial statements, you can use either one in the U.S. In Europe, for international financial reporting standards, you cannot use LIFO.
Right.
LIFO is a uniquely American thing. So in the United States, you have the choice between FIFO, LIFO, or another inventory method. Weighted average is one. I'll share another one with you in a moment. The IRS says if you're going to use LIFO for your tax return, then you have to use it on your financial statements too. So if you're going to use LIFO in one, they want you to look bad for your shareholders. And the fact is, most U.S. companies use LIFO. It's a little more than 50% use LIFO because they'd rather have the tax savings, you know. But the IRS says that if you use LIFO on your tax return, then you got to use it across the board. Now, there's another system called weighted average. What weighted average says is that you just take the average of all of these. So in this case, if you take the average of these 6 figures, you would get 32.5 cents.
But if you keep using LIFO, wouldn't the stuff that you have already in your inventory, won't they spoil or won't they?
No, because the thing is that you're always going to manage your inventory using FIFO. Always. For exactly the reason that you said. Otherwise, the milk is going to spoil. But when you report to the IRS, when you figure out, you need an assumption to determine which item you sold to figure out cost of goods sold. So when you're doing that accounting work, you could assume LIFO, even though it's a bad assumption. So when I want to know how much did the can of soda cost, I could say, well, I'm using LIFO, so the 2 cans of soda that I sold, these were the cans of soda that I sold. And that's the cost, and that's it. Even though I sold the oldest ones, you see?
But isn't that kind of cheating? Or
It's legal. It's legal, everybody does it. It saves you money on your taxes. So what you could do is LIFO, and you reduce your taxes this way, and you assume that these are the ones that are still here. But again, remember that it's just a bad assumption. That's all for purposes of financial reporting. And by the way, LIFO has other benefits too that I'm just not getting into because I don't have enough time. There are other good reasons to use LIFO. But if you were to use weighted average, and let's say you sold 2 cans of soda, how much do they cost? They would cost 2 at 32.5 cents equals 65 cents. No, I'm sorry, 60. Yeah, they sold 65 cents in total. So then your income statement would be, you sold 2 at $2, and they cost 65 cents. That would give you gross profit of $1.35, and an inventory value. Well, 32.5 times 4 cans of soda would be $1.30. So weighted average really just kind of uses both methods. It kind of straddles the two. There is one other method, and it's called specific identification. The way specific identification works is keep track of the cost of each and every unit individually. That's how specific identification works. So it's not practical to do that for cheap things. But when can you think it would be practical to use specific identification and keep track of the cost of every single unit individually? So you would do that when, in a situation when the items are unique and expensive. So for example, let's say you were in the diamond jewelry business. I bought my wife's ring, and I went to the city, and then you pick out your diamonds, and you pick out your setting and all of this, and you pick out your diamonds, and then you get it checked out. It was a whole long ordeal, right? But I learned a lot about diamonds and stuff. And I'm just telling you probably what you know. Every single diamond is unique. And it's funny, they have like these markets and stuff where they buy and sell diamonds. They're like old-fashioned markets. And people walk around, they just have these paper bags with diamonds inside. And they open up the paper bag and they pour it on the table, and there's like 4, 5, 6 diamonds, and then they look at each one of them like, okay, this is some. They weigh them, they look at them, they rate them, and all that. But every one of them is unique. So what would you do? You would keep track of the cost of each one of them individually, because each one is unique, and each one has a different value that's attached to it. So say anyone here ever work in a jewelry store? What a jewelry store will typically do, and this could be a mom and pop jewelry store or an expensive one. The only exceptions to this would be like costume jewelry or inexpensive jewelry, is they, at the end of the day, it's a whole thing they go through. They take all the inventory out of the, display cases and lock it up in the vaults, and they count it because they want to make sure that everything is there. And each item has a tag, and the tag usually has a code which tells them how much it costs, because they keep track of the cost of every item individually. Now, if it's gold jewelry, that might be a little different, because then they might just keep track of it by weight. But usually what they'll do is there'll be a little tag on it, and you'll see this, like those jewelry markets on Route 4 and stuff. You'll see that there's a little tag on every item, and it has a number on it, or a code, really. And the code tells you how much that it costs. It doesn't tell you, it tells them. So then when you say, how much is this? First thing the salesperson does, they look at the tag, and they pull out the calculator, whatever the price of gold is today. And then they'll do a little math, like, okay, it'll be $1,200. And then you know what you do, right? You say, oh, well, how about $900? And then the negotiation begins. And if they know how much it costs, then they know their negotiation position. And so knowing how much an individual item costs, now you're going to have the same kind of thing for automobiles, because each automobile has a unique set of options on it. So it has its own costs. You know the sticker in the window when you buy a new car? Part of that, it says it has dealer invoice on it. I believe, though, that's not really what the dealers pay. The dealers pay something less than invoice. But that tells the dealer how much the automobile costs, and therefore it tells them how much they can sell it to the consumer for. And that would, again, be specific identification, because it's not like cans of soda where every one of them is the same. Okay, so that's sort of all the different inventory systems. Now, take a look over here. Let's look at General Electric again. And here you can see GE has 3 classes of inventory. And again, look at what they said here. It's determined using LIFO, and there's other U.S. inventories are determined using LIFO, because you can do that in the United States. And other inventories are determined using FIFO, because you can't use FIFO outside the United States. Excuse me, I shouldn't say it that way. Only U.S. GAAP allows LIFO. I don't think any other countries anymore allow it. Okay, so here you can see the inventory values. Now these values are really at current cost, or FIFO. It's not really clear from this, but it's at current cost, or FIFO. Then they make a subtraction to revalue it to LIFO. So this way you would know. So let's answer the question. Which system do they use? They use both. And we didn't talk about the consistency principle. The consistency principle says that you use the same accounting method every year. But it does comply with the consistency principle because they use the same method every year. Now, December 31st, year 6, that's over here, the balance sheet would have reported inventories if they had used FIFO. What would that be? 9645 or 9039? That'd be 9645. This here is the FIFO number. And what would it be using LIFO? 9039. So now let's look at the difference. You can see here, I talked about this before. If prices are going up, remember that FIFO gives you more profits, while LIFO gives you higher inventory value. LIFO gives you lower profits and lower inventory value. And that would be flipped around if prices were going down. So circle the effect on LIFO. As a result of LIFO, G reported 606 more or less in inventory. Less. And how about cost of goods sold? They've reported more cost of goods sold because of this. Right? Because the inventory costs more. And how about income before income tax? Less. And how do you think this would affect their tax expense? Well, assuming a 40% tax rate, that's a tax difference of $606 million times 40%, or $242 million. Is that less tax expense or more tax expense? Less. And it's a good question. I think we should talk about it, but I'm not going to talk about it now. Is that ethical? Is it ethical to use LIFO to lower your taxes? The evaluation to LIFO, did it decrease or increase? You saw here that the revaluation decreased. And that would, by the way, indicate there was LIFO liquidation. Don't worry about what a LIFO liquidation is. The period of inflation, the cost flow assumption resulted in the lower taxable income is in a period of inflation, which cost flow assumption would give you the lowest taxable income? FIFO, weighted average, or LIFO? LIFO. This tax benefit is achieved by allocating the higher, more current inventory costs where? Where do the higher costs go? To cost of goods sold or to ending inventory? Cost of goods sold. And GE would appear more profitable if it used FIFO. But would it really be more profitable? No. Why not? Yeah, because it's paying more taxes. That's a funny thing. Or one could argue that it's the same, and there's technical reasons for that, but I'm not going to get into it. Okay, now we're going to do a little, to handle this a little, look at this in a different point of view.